everybody. Welcome back to the Integrity IPG podcast. My name is Jordan Pahalik, one of your two co-hosts. Today, I am joined with the other co-host, Dylan Webkenberg, also CFP. How you doing, Dylan?
I'm great. How you doing?
Good. And then as well as reoccurring guest, CFP, founder and owner of Integrity, Nick Sanchez.
What's up, guys? How's it going?
Great.
How are you doing?
Doing great. Good.
Yep. So this will be coming out in hopefully about a week from now, but today we have Game 4 for the Pistons tonight, so a big one. Got to jump on that right away.
Big one.
So that'll be exciting. But other than that, we've got another exciting episode for you guys today. Today we're going to be talking about the financial surprises when you are entering retirement, as well as where that income actually comes from. So this one will be focused towards people getting close to that retirement age, as well as people in it as well. So we're going to start off with, kind of talking about where that money comes from and, like I said, again, what surprises you might have, because I feel like a lot of people think entering retirement, I'm just going to live off my savings, but that's not generally the case. So, it's a lot more complex than that. So we're going to talk about where those sources of income come from and what that really looks like.
A lot of it for sure is age-based, right? Because you could retire in your 50s, you could retire in your 60s, 70s, so it kind of depends on where someone's at in life. But Social Security is really kind of like the income floor for most people when they get to retirement. They give you X amount per month coming in that just kind of like covers your necessities, and then anything above and beyond that, hopefully you have investments that you're drawing from, IRAs, 401ks, or even like some people want to retire. That's the other variable. What does retirement mean? Because some people want to fully retire. They flip that switch. They're like, I'm done working. That's it. Other people just want to retire from the grind, or maybe whatever it is that they've done for 20 or 30 years, but they've envisioned themselves working in some capacity, like part-time at a golf course or Home Depot or something like, and maybe they have a little bit of income coming in from a part-time job. So yeah, there's a lot of factors that I guess determine what kind of income someone can count on in retirement.
Yeah. That's, and again, one of the other ones, right? So Social Security, you're getting that for sure, depending on how you set yourself up and plan beforehand. Another one that's huge is the retirement accounts. So whether that's 401ks or IRAs, that's another huge, usually portion of somebody's retirement income. And Dylan, if you could kind of talk about some of the different, what would you say is because people might not have the best understanding of like, what's the difference between a 401k and an IRA, and how do those kind of work into your whole plan?
Yeah. I feel like what we've talked about so far, Social Security and retirement accounts like IRAs and 401ks are like the two most common retirement assets that people are used to dealing with. The difference between 401ks and IRAs is that 401ks are like employer-sponsored plans where you're contributing usually pre-tax money into a plan, and then your employer's matching that based on your salary, whereas IRAs are like a standalone retirement account. They're both qualified money. They're both invested with, they're tax-efficient accounts, but 401ks are through an employer. IRAs are like a standalone account.
Okay. So if I were to have enough assets where I don't need that money, would I still have to be withdrawing that at a certain age or time, or can I just let that money grow for as long as I want and pass it down to
That's
my kids?
That's a good question, right? So yeah, the government usually says that you can't just invest in these accounts and let them grow tax deferred for your entire life. It's at a certain point the government says, no, you have to start withdrawing this and paying me taxes. And it's kind of like a moving target, but for most people that age is 73 years old when you start having what are called required minimum distributions. And essentially, like I was saying, it's when the government says you've deferred taxes on this money for too long now, you have to start pulling out money and paying tax on it.
Okay. Yeah, that makes sense. As well as Social Security, right? Because there's the window of when you can start withdrawing. What would you say is like, again, it obviously depends on situation, but in terms of when would you say it's right to start at the early age of 62 or wait until age 70?
That's definitely Social Security is definitely one of those things where there's not a right or a wrong answer, because there's, 62 for the most part is the earliest you can file. And if you file at 62, you get reduced benefits for the duration of retirement. And there's also, if you do it at 62, there's income limitations. So if you had a job and you were earning income, that income you're earning might cause your Social Security benefit to be reduced. Depending on your date of birth, for most people, 67 is full retirement age, which just means you can take Social Security at 67. And even if you had a job that was paying you an income, your income wouldn't in any way reduce your Social Security benefit. So again, this is getting into some of the complexity of Social Security, but your age is a big factor. Do you have a job that's paying you income? That's a factor in determining, do you need Social Security? Because every year that you delay taking Social Security, it's like a 7 to 8% increase in the amount that you get. So if you're earning an income and you have a job and financially you're comfortable, you might want to hold off on filing for Social Security, just because by waiting every year, you're getting a guaranteed increase on the amount. Somebody's overall health would definitely be a factor, because if you're in poor health and you don't know how long you're going to be around, you'd probably want to file as soon as you're able to.
Yeah.
If you're in good health, you're healthy, you have good longevity in your genes, you plan to be around for a long time, that would be an argument of delaying longer, even up to age 70, which is the longest you'd want to delay taking Social Security would be age 70. Because past 70, you get no increase in your benefit at all.
Yeah.
So yeah, there's a lot of factors that go into it for sure.
One other one too that I feel like we usually, not us bringing it up, it's usually clients mentioning it to us, is, will there even be Social Security for me at that time? And so that's another just part of the whole equation. If you believe that Social Security will be there, if you do, then obviously it makes more sense to defer and wait. But if not, then that changes things as well. So
Yeah.
Yeah, we've heard for a long time about how Social Security in general is running out of money and underfunded, and there's risk of it depleting. And so there's math that can help you determine if you should file for Social Security or if you should wait. But some clients, when you have the conversation, you show them the math, they just say, you know what, even with all the numbers, even though they support waiting, I just want to take it right now because I don't know how long it's going to be around. And that's not you can't say that they're wrong, because
Right.
we don't know. You guys are in your 20s. Who knows what it's going to look like in 40 years, almost 50 years, when it's time for you to consider taking it.
Right.
There's going to be a lot of changes. Maybe they're going to push the age later that you're able to first file, or there'll be some type of income determination to see if you even need it. There's a lot of things that could change between now and then, but it definitely seems like Social Security in general is kind of in shaky territory.
Yeah. And I feel like anything money involved, when you look at your big picture, there's always an emotional aspect. And I know we've talked and brought this up before, but it's not always like cut and dry, this, look at numbers, and that's it. There's emotions are tied to money. That's how things go with everyone. So obviously a huge factor. A couple other things, a lot less, it's not a lot of them out there nowadays, but pensions, still a real thing that we see, especially with retirees nowadays, because it used to be a lot bigger thing. So that's another, that's basically just like a paycheck. So you stop working, you retire, and it's still it adds that fixed income like you still are. So that's a pretty simple and easy one. And again, a lot of people our age are probably not going to have to deal with that more so, because it's just not as common these days. But there's obviously ways to supplement that in terms of annuities, or we can kind of create your own pension, so to say.
Nope.
Another one would be brokerage accounts. So whether it's stocks, bonds, mutual funds, setting after-tax accounts, and there's a little bit more tax liabilities and tax planning that come along with those when that time comes. What would you say, as I bring that up, what would you say is some of the strategic planning that is involved with those accounts when that time comes?
Yeah, so for a non-IRA, just regular brokerage account, like an after-tax investment account, that's where you have gains, unrealized gains. And if you want to pull $10,000 out of an account, you might have to sell holdings to free up the $10,000, because you can't go to Target and buy things with Amazon stock. You got to liquidate the stock to get money in your pocket.
Yeah.
So if you have stocks, you have to sell them to get cash. And in an after-tax account, when you sell holdings, you might have a gain that you have to pay tax on. So in retirement, gains planning and figuring out which holdings do I sell to get the cash that I'm looking for? Because if you can find certain things that have appreciated and have gains, and maybe some stocks that have gone down in value and they have a loss, you can pair them up, and you can get the cash that you're looking for without any big tax bill. So there's a lot. I mean, when you go from being an accumulator and building your wealth to becoming a retiree and a distributor, there's a lot of strategy that comes into planning distributions, and there's a lot of expertise and detail that matters. So after tax account is definitely where you see that a lot in tax planning.
Yeah, for sure. Like staying within certain tax brackets as well. Like we've gone through 4 different retirement types of money: Social Security, 401ks, pension, and then just after tax accounts. With the 401ks and Roth IRAs and IRAs, those are like tax efficient accounts. You can sort of help plan. You can plan a client's income within the certain tax brackets based on where you're drawing this money from. Like Nick was just saying, if it's from an after-tax account, you can be a little more savvy and strategic with the funds you're pulling it from and selecting which ones have realized gains and which ones don't. Any money you pull from a pre-tax IRA is all going to be 100% taxed. So sort of knowing all of these things, you can help calculate out where can we pull money from these different accounts for a client while keeping them within certain income limits. So yeah.
Yeah, then so now moving on to the surprises, I feel like a lot of retirees don't realize or understand until they get to that time, because obviously you're entering a new phase or stage in life, so you're obviously unaware of what's going to come. So we're just going to go through a couple of them. The first one is obviously taxes don't disappear. Again, growing up and early on, you're in your 20s, your 30s, you think you're going to save and accumulate the money, but you don't realize that you're going to be drawing from these different sources, and that money is still going to be taxed. If you're taking out $200,000 from an IRA, you're not getting $200,000.
Right.
So that would be one of the big ones early on. And again, like you guys have kind of already went over it, there's strategic planning that can go along to stay within ranges. But the second one I'd want to ask you guys about is healthcare costs, because again, that's not something many 20, 30, 40-year-olds are aware of. What does that usually look like when somebody is entering that phase of life?
Well, that's definitely a big variable that you can't control what your health medical related costs are going to be in retirement. So that's one of those things where you are aware of it and can kind of prepare for it, but everyone's health and medical expenses in retirement is going to be different depending on underlying conditions or how your overall health is. But typically when you reach age 65, that's when you transition into Medicare, which is like government sponsored health insurance, healthcare. And then you get like a Medicare supplemental plan to go along with base Medicare. So typically your costs for health insurance come down when you get age 65. Not always, but a lot of times that's the case when you go from like a privately funded health insurance, either through your employer or just like an individual plan you have for your policy. When you get age 65 and you're able to move into a Medicare plan, usually your costs go down, not always. But then the other big unknown is like long-term care type costs, assisted living, nursing home, skilled nursing at home type care. That's a big variable. Like if you had a need for that can be expensive and can add up pretty quickly.
Yeah. And Dylan, I have a question for you. So obviously the other variable is how long am I going to be retired? If I stop working at 65, I don't know if I'm going to be here till age 70, 98. How do I make that money last then for an area that we don't know how long it will last?
That's a good question, and I guess like we've sort of answered for a lot of these things is it depends on what you want in retirement, and what you think your life expectancy really is. We usually, I guess, map out clients living to like age 95. It seems to be a pretty reasonable / over conservative estimate in like a long lifetime. But kind of what we do with clients like that is we show them, here's how much you have in your retirement assets. Here's how old you are now. Here's a conservative rate of return. And then we use a financial calculator to help show them how much can they pay themselves in income in retirement from this big bucket of money, essentially. So to answer your question, it's like there's so many assumptions and variables that go into this calculator that we use. It would be too difficult to tell you any one thing is like the reason why someone's able to last 25, 30 years in retirement. It's all dependent on how much money they want in retirement from their assets, how much they actually have, what rate of return you're assuming over 30 years. It's just a big conversation with someone. It certainly couldn't be answered just by saying like, do this or do that, and then you'll be good. You know what I'm saying?
And that kind of, I think, leads into the next question perfectly. For both of you, I mean, do you guys plan on, when you both enter retirement, do you plan on, your income lowering, being the same, hopefully being more? Because, I mean, with all that free time, you're going to want to, travel, do all these other things, spend money on your kids, spend time with them. What do you guys see that time looking like for you down the road?
Yeah, that's one of the things, like most people, if you ask somebody, what day of the week do you spend the most money? What would you say? What do you think is the answer?
The weekends.
The weekend, Saturday. And the reason is because you're not working, so you have more free time. And when we have free time, money finds a way to get spent. So when you're retired, essentially every day is like Saturday, right? You have a blank canvas for the day, and it's easy to spend money. So yeah, sometimes people think when you retire, if you're earning an income, when you retire, all of a sudden your income's going to drastically go down. That's not always the case, especially if you do proper planning and really do a good job of investing and putting money away. You shouldn't have to have a reduction in income just because you retire. That's kind of the goal.
Right.
So hopefully, if you do a good job investing, growing your wealth, you can retire on a Friday, and on Monday in retired life, your income is the exact same by having a portfolio to draw from to go along with Social Security. And that's just being disciplined at an early age, putting money away, and doing that favor for your future self, basically.
Mm-hmm. Yeah, Nick, literally, I would have said the exact same thing. The idea is that you earn a certain income going up until retirement, and then once you get to retirement, you want to keep earning that same income. You earn it just a different way, is that you earn it from your retirement accounts that you've saved into all these years. You start paying yourself that same income, but that is why we save and contribute to 401ks and things like that, is to eventually replace the exact same income that we currently have. Yeah, we definitely wouldn't want to have any drop in income for sure.
Yeah. That's got to feel a lot better too. You're not working 5 days a week, 40 plus hours, but you're getting the same thing coming in the door. But that pretty much wraps it up for this episode. Again, going through a couple of the key points we talked about. It's going to come, your income's going to come from multiple sources. So there's obviously strategic planning that will be involved. Because at the end of the day, you want to, pay the least amount of taxes you can and have the most amount of money actually coming into your pocket during that time. So it's really about turning your savings into income. Do you guys have anything else to add or that we maybe missed?
No, I think the big takeaway is just that retirement planning is complex, and there's a lot of variables and nuances that go into it. So I think anytime you transitioning into that phase of life, it definitely is wise to consult the experts, which I like to think of our team as being experts in that field. And the other thing is, lastly, of course, go Pistons. Hopefully we pull out the win tonight.
Yeah.
Right. Yep.
Big one.
I was just going to say, kind of to the same point that Nick was saying, is that we like to say that it's not about having one 30-year plan. It's about having 31-year plans in retirement, because things will change and your life will change, and what you want to do it's all fluid and will change. So because of that, it makes sense to work with someone over the long time. Each year you're meeting with them to update and go forward. Yeah.
Yeah. Like Nick said, hopefully the biggest changes will be in the Eastern Conference Finals in about a week.
That's right.
So thank you guys for listening in again, and we will see you next week.
The information discussed is educational in nature and is not and should not be construed to be investment advice. For advice appropriate to your specific situation, please consult a financial professional. Securities offered through the ON Equity Sales Company, member FINRA/SIPC. One Financial Way, Cincinnati, Ohio, 45242, 513-794-6794. Investment advisory services offered through ON Investment Management Company.